So there are 5,000 companies in the stock market and you want to figure out where to invest. How will you choose out of 5,000, which are those top 10 or top 20 companies that you want to choose for your portfolio? If you are a beginner, I would suggest you own at least 20 stocks. If you are a professional, you have some experience in the stock market, I suggest you own 10 stocks, which is a very concentrated portfolio because you know how to do fundamental analysis of companies. So if there are 5,000 stocks in the stock market, and if you were to choose only 10 or 20 stocks, let's say 20 stocks, so that means you will have to learn the art of rejecting 4,980 companies, right? So which means you need some kind of a filter to remove these companies from your radar, so to speak. So how do you do that? What are the filters that you use to screen stocks? I want to suggest 7 points here. Number one, don't invest in companies that generate a negative operating cash flow. If you go to the cash flow statement of any company, you will find that some companies are spending more than they are earning. So there is cash flow from operations, cash flow from financing, and cash flow from investing. If you look at cash flow from operations, that is the amount of money that the actual business is making. So cash flow from operations comes after deducting all the expenses, the raw materials, the salaries, the taxes, the marketing expense, everything. When you deduct all of that, you come at a number. And if that number is negative, it means that the company is spending more than it is earning. That's the first filter. If the company is not making money by doing business, you have to reject the company. Just this single filter itself will remove at least 50% of the stock market. So I would say out of 5,000 companies, 2,500 companies can be rejected just by this single operating cash flow criteria. If there is negative cash flow in any year out of the past 10 or 12 years, even in a single year, there is a negative operating cash flow, you filter it out. You don't invest in that company. Stay away from such companies. Second, negative free cash flow. If a company produces negative free cash flow, you stay away from the company. So what is the difference between operating cash flow and free cash flow? So free cash flow is calculated from the operating cash flow. So out of the operating cash flow, if you deduct the capital expenditure of the company, if you deduct the interest payment, if you deduct the loan repayments, what you are left with is called as the free cash flow of the company. This is the amount of money that can be given out as a dividend to shareholders, or this is the amount of money that can be retained. This is the amount of money that can be used to buy back shares, or this is the amount of money that can be used to acquire other companies. Lot of things can be done with this money. So this is called as free cash flow. Any company that generates negative free cash flow, again, is spending more than it is earning. So basically the company is not making money. Again, if you add this another filter to your screen, you will find that 70 to 80% of the stock market is junk. So it's not worth investing because these companies do not generate free cash flow. Even some of the blue chip names, if you see, they do not generate a positive free cash flow. So just these two criteria, negative operating cash flow and negative free cash flow, if you just use these two criteria, you will find that you can reject thousands of companies because it's not easy to generate cash flow on a sustainable basis. Doing business is not easy. Number 3, this criteria is very simple. On the profit and loss account statement, just go to the net profit value and see whether it's a loss-making company or not. Does it really make profits? So if the company itself is reporting a loss, then you stay away from the company. As simple as that. The company itself is telling you that we are making losses. Why would you invest in a company that is not making money, that is reporting losses? You have 5,000 companies in the stock market, out of which you only want 20. So why go with a company which is already in making losses. So third point is loss making company. Any company that reports a loss, you filter it out. Number 4, the PE of the stock is greater than 50, 50. Now, professional investors don't generally look at the price to earnings ratio, the real professional investors, uh, because we look at free cash flow. We don't look at price to earnings multiples. But this is a crude filter which we use because anything above 50 is extremely overvalued. Even 50 is very overvalued, but in some cases there is hidden or embedded value in the company. So any stock which has a P multiple of more than 50, I would stay away from the company just to be on the safer side, because generally these are growth companies. So investors are overpaying for these companies, and the risk with these companies is not that the growth will stop. The risk with these companies is that the growth might slow down. Growth stopping and growth slowing down, these are two different things. Even if a little bit of slowdown investors see, immediately the stock might crash 50%, which has happened with many growth companies in India recently. So that is the risk with these kind of stocks. You might find yourself invested in a very high growth company. The revenue has grown 10 times, and suddenly you see that the stock has crashed 50%. That is difficult to digest, at least for a beginner investor. Okay. So stay away from stocks that are overvalued. This is a very crude filters. If the PE of the stock is more than 50, you stay away. Wait till the price comes down. Okay. There is no hurry. There are 5,000 companies. We only want 20 out of that, and that's it. Okay. So don't be impatient. Don't invest in overvalued companies. Number 5, there are certain sectors which are obviously not worth investing in. So for example, cyclical companies like sugar companies or cement companies or automobile companies, these are cyclical businesses that go up and down with the economy, and it is very difficult to time these cycles. That is why I stay away from cyclicals. That itself will eliminate around 20 to 30% of the market. And also some historically notorious industries that don't make any money at all. For example, airline companies. So stay away from airline companies because the costs are very high. It is not an easy business. There is no free cash flow. In some cases, there is no operating cash flow. If the company is not making money, how will the shareholder make money? So cyclicals and industries where there is no money at all. Number 6, there are some companies, if you look at their capital structure, the balance sheet, they have a very complicated capital structure. They issue warrants, they issue options, then convertible for preferreds, convertible bonds, and whatnot. It's very difficult to analyze such companies. It is very difficult to analyze the effect of all these capital issuing instruments, so to speak. It is very difficult to analyze the effect of these instruments on the value of the company. So I like to stay with clean companies, one share, one vote, as simple as that, no dilution in the equity. I like simple companies where the capital structure is very easy to understand. If a company is doing too many stock splits or issuing warrants and options and convertible preferreds, convertible bonds and triple option convertible debenture, this is all technical terms. These are all accounting maneuvers or ways to raise money. I don't like all of that. A company which is in a stable business, which is doing good business, doesn't need to do all of these gimmicks. Okay. So stay away from companies which are issuing warrants and options and convertibles and all of these, which are difficult to analyze. For all of this, you need an Excel sheet. And basically, if you need an Excel sheet to analyze a company, there itself, we should straight away reject the company. Okay. Number 7, don't invest in companies that have got too many subsidiaries. Okay. Subsidiaries or associate companies or companies which have a lot of related party transactions. It's very difficult to analyze that company, because how would you look at a subsidiary? A subsidiary may be a private limited company, and not much information would be available on that company. Basically, a company that is doing good business doesn't have much subsidiaries. There are simple companies, simple products, easy to understand businesses. Consistently, year after year, they keep making money. They don't need to acquire companies because their business itself is doing well. They are earning money. They keep giving dividends, good operating cash flow, good free cash flow. They don't need to create any subsidiaries or do spin-offs and all of these things. It becomes very difficult to analyze such companies, especially for beginners. So any company that has got a lot of subsidiaries and I don't know how to arrive at a value for these subsidiaries, I stay away from that. So basically these were the 7 filters that I use. If you use these filters, at least out of 5,000, you can easily reject 4,000 or 4,500 companies, just these 7 filters. So number 1 is negative operating cash flow. Number 2 is negative free cash flow. Number 3 is loss-making companies. Number 4 is PE of the stock is greater than 50. Number 5 is cyclical companies. Number 6, companies that issue warrants, options, and convertibles. Number 7, company has too many subsidiaries. So those are the filters that I personally use to build my portfolio. Thank you so much.